Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So this week on the podcast, I had the chance to speak to Alex Wright, who is the manager of Fidelity Special Values Investment Trust, as well as the open-ended equivalent, Fidelity Special Situations, the latter of which was Anthony Bolton's first fund way back in the 1980s, or was it even 1979? I can't remember. In any event, Alex is the third manager of this trust, and today it has a market cap of around 1.2 billion, second largest in the UK all companies sector. And has, I think any fair-minded observer will say, has put together a very impressive performance record over that period since Alex became the manager, which originally was in 2012. So, Alex, very good to have you on the podcast, and very unusual to have you on a podcast at a time when the UK equity market is outperforming the US market. That's something we haven't said for a while. Very good news that that is so. So let me start off by just asking you where you think the UK market is at present. It's still looking attractive, I think, despite performing much better this year. What's your kind of big picture take on the UK equity market at the moment? And we'll go on to talk about your fund and what you're doing with it.
Yeah, you're right, Jonathan. It's a great time to come on. Thanks very much for giving me the chance to chat because it has been a really good period for UK equities and for the trust. Actually, Special Values, we're recording this just at the start of July, and just at the end of June, I think we hit a new all-time high for the trust, which is great. And we have delivered, I think, over the last 12 months, about a 25% total shareholder return, which is a long way ahead of the US market, which in pounds, given what's happened to the dollars, is up only sort of about 5% over that period. So it's not just that the trust and UK equities are doing well, they're doing incredibly well compared to the US market over the most recent period. Well, I think the good news is that the UK market is still a very cheap market compared to other markets out there. So we've moved up from maybe the real lows that we saw sort of 2 or 3 years ago. But overall, the UK market's only on about 13 times earnings, which is still slightly below the long-term average. Whereas even after that more lackluster performance, the US market's still on 22, 23 times earnings. And other developed markets are maybe on sort of 15 or 16 times. So I think versus other available equity options, the UK market still looks very good. And then in particular, because the UK is a very broad market, lots of different choice, there's definitely a lot of cheap stocks within the market, particularly as you go down the market cap spectrum to more sort of mid and small cap companies.
Right. I mean, we could talk about that in terms of what's been going on in the world or what's been going on with the UK economy. But of course, a lot of your companies, you have international exposure. But at the same time, we've been reading for months now, indeed, that there have been outflows from UK equity funds in aggregate for nearly 5 years now. So how do we reconcile this apparent contradiction that the market is doing really well and funds are flowing out of UK equity funds?
Yeah, so obviously markets don't do well unless there's more buyers than sellers. So clearly someone is buying the UK market because you're correct. UK investors are not buying the UK market, they're selling the UK market, and they're mainly buying the US market, which I think is absolutely the wrong thing to be doing. And I think they're being backfilled by actually US and global investors buying the UK. And you can particularly see that in terms of when you look at, particularly over the last quarter, I'd say notably the mid-cap index has done better in the afternoon than it does in the morning, which is a clear sign that the sort of people who get up somewhat later in the day in the US because of the time difference are the buyers. And I think that's because they're recognizing the value, but also, I guess, the sort of the geopolitics of the US market and the movement in the dollar. The dollar has sort of been a one-way bet for years, if not decades. And actually, if the dollar is not going to appreciate, that makes international equities much more interesting. And you don't need to move very much of your allocation out of the US if the US is 70% of the benchmark and the UK is 3% of the benchmark to really make quite a big difference. And so, while it's not UK investors buying, I think it is those US investors buying because they see that huge valuation gap between their market and what are very good companies quoted in the UK Clearly, as a US investor, it's easier to invest in the UK than it is probably any other market globally. Sort of same language, similar levels of disclosure, good management sort of access, and lots of international diversification, because only 25% of earnings of the UK market actually come from the UK economy. 75% are a subset of global earnings.
So we've seen the impact of that buying on the discount as well, the marginal buying on the discount of the investment trust. Have you actually been getting inflows into the open-ended fund as well, out of interest?
So we have seen a flicker of interest. So the fund has been in outflow every year since Anthony stepped down on the fund in 2007. But over the last rolling 12 months, we've had about a £50 million inflow. Now that is pretty small in the greater scheme of a £3.5 billion fund, but it is a positive number compared to every other rolling 12-month period basically being a negative number. So I wouldn't say it's a flood, but it is a trickle.
And how much of your trust and the fund itself been helped by M&A activity? Because we know there's been quite a lot of M&A going on. Some corporate buyers and private equity buyers have been recognizing there is some value in the UK market. Has that been a significant factor for your particular style of management?
It has been, but I wouldn't say any more so over the last 6 or 12 months than it has been over the last 4 or 5 years. So I'd say ever since we saw the vaccine coming out of COVID, not quite 5 years ago, you started to see M&A pick up in 21, and we've had a steady stream of that through 21, 22, 23, 24, and continuing. I suppose what's been heartening is even though there's been a lot of market gyration, a lot of movements in currencies, policies, etc., year to date, that M&A has very much continued, and we've had a bid for our holding in Warehouse REIT recently, a bid for our holding in H&T, our bid for our holding in Backabor also. So that has been a feature and continued to be a feature recently.
Yeah. So I can't resist asking this question. You don't have to answer it directly if you don't want to, but there's been an awful lot of noise about how the UK market, the equity market needs reforming. You know, we've got to change the way we organise things over here. We've got to get rid of stamp duty, many people say, campaigners and so on. But do you actually think that there are structural issues here that could be addressed and are still not being addressed? And if they were done, would they actually contribute to the UK market doing even better?
Yeah, so I think that's the thing. I think the UK market is doing just fine. And actually, sort of over my tenure, the last 12 years or so, the performance of the UK market has actually been almost identical to the per annum performance we've seen over the whole 30 years of the trust. Sort of UK market doing about 7.5% per annum. So I don't think there's anything wrong with what the UK market is doing. And then we've been able to add a lot of alpha to that, to about 4% per annum, which again is not so dissimilar to the 30-year view of sort of 4.5%. So this is a market that can produce good returns where you can add a lot of alpha and continues to be so, as it has been for the last 30 years. Now, could there be improvements? There definitely could be improvements. So I think clearly stamp duty is one thing which is a bit of an historic relic. Very few other markets have stamp duty. And so that is a cost of doing business on the UK stock market that doesn't exist elsewhere. So clearly, if you got rid of stamp duty or limited it, particularly to not charging on AIM companies, but other small companies, I think that would be particularly helpful for liquidity and trading for retail investors. And obviously, there's things like pension companies used to be much bigger owners of the UK stock market. They aren't now. Clearly, if more of people's defined contribution payments went into the UK stock market, that would be helpful. But to be honest, I don't think actually there's a lot of doom and gloom talked about the market, whereas actually I think things on the ground are pretty decent, and this is a good place to invest, as it has been for quite a long time. We're very lucky in the UK that we have attracted, because of our sort of place in the centre of the world and good capital markets, a deep pool of international companies here. That's why the market is 75% international and only 25% UK.
Well, would you not be happier if some of these companies that remained listed in the UK rather than in the US? We know we've been a number of high-profile examples where companies have moved their listing from here to the other side of the Atlantic and been rewarded with higher multiples and so on. But what do you make of that? In other words, is that just the fact that the US market's become very expensive and it's therefore an easy way to get a better valuation? Or is there something more to it than just that?
No, you've hit the nail on the head. Clearly, as a CEO or an owner of a business, you want your business to be valued at the highest possible level. And the US market and private markets are paying way higher multiples than is currently in the UK or indeed elsewhere. To be honest, it's really a US versus the rest of the world phenomenon that there's that huge difference. Now, to me, I want to be in a market that's undervalued. An undervalued market gives you the optionality of there being a re-rating, the ability to add value by buying back stock at the wrong price, the potential that you could get taken over. Whereas if you're at a high valuation, that doesn't give you options. There's pretty much only one way that that valuation can go.
So out of the UK market, taking the open-ended and the investment trust together, that's quite a big pot of money. How many stocks are you invested in across that combined universe, should we say?
So there's about 80 stocks in the open-ended product and about 90 in special values. And I'd say that the investable universe, if you look sort of £100 million plus companies in the UK, there's maybe 1,000 companies that we can choose from. There's also obviously the ability to do up to 20% overseas. We're using a bit less of that. So we have been as high as 20%. Today, that would be down to maybe 11 or 12%. And that's mainly represented actually today by sort of Irish companies. So we've got some quite large positions in Allied Irish Bank, Cairn Homes and Glenveagh Homes, as well as Ryanair.
Okay, so obviously the point of my question was you're not running out of opportunities despite these companies going off to the States or whatever they might be doing.
No, it's not that long ago the UK had a huge new batch of IPOs back in sort of 2021. So that did refresh the market. Obviously, since then, there's been a dearth of IPOs, but that's not just a UK phenomenon. That's a global phenomenon as you sort of saw interest rates rise. And again, there's starting to be a differential between private market and public market valuations. That caused an issue for clearly those private valuations trying to get an uplift onto IPO, which has created that sort of indigestion in both the UK, but also globally.
Right. Let me just ask you then, I know you're a stock picker and you deliver your alpha by picking stocks successfully. I had to just ask you a quick question about Trump and then a quick question about the Labour government and the budget and so on, which obviously had a direct impact on a number of domestic companies over here. So just take Trump first of all. Do you think that the markets have got the measure of Mr. Trump now as far as it's reflected in what you see every day as you go about your business?
Oh, I think that's almost impossible to say. Obviously, the difficult thing is what Trump says on a daily basis changes. So I think there's a large degree of skepticism now about Trump doing what Trump says he's going to do, because there have been many cases now where he hasn't done that. But I am slightly worried that the market has become very relaxed about tariffs, which obviously are a net negative for the US and the global economy, because there seems to be a sort of consensus that these are going to be negotiated down to quite low levels, which may be the case, but may not be the case. And I think it's very difficult to work out exactly which one is going to happen. But I think the consensus is that it's going to be fine.
And it may not be, indeed.
Yeah, and who actually knows? Yeah, and when we'll find out or not find out, because deadlines also seem to be quite malleable and slippable as well. So that is an ongoing, unfortunately, something we're going to just have to pay attention to.
And he thinks he's a great negotiator, so he says, we've got a deal, and then he comes back and says they want a bit more. That seems to be a pattern as well, which creates more uncertainty and so on. If you talk to the companies that are in your portfolio, particularly ones that are exposed or potentially exposed to tariffs, what kind of feedback are you getting from them? What kind of message are you getting from them? How are they coping? Are they adapting or are they still moaning about it?
So again, the interesting thing about the UK market, and we talked about this sort of at the time, and it's interesting, people haven't asked me about this for sort of 2 or 3 months now, again, which maybe shows how sort of relaxed the market seems to become on this, is that actually the UK market and my portfolio isn't particularly exposed to tariffs, because the UK economy and the UK market is overwhelmingly a sort of services market. There aren't many big exporting companies out of the UK, and there aren't many quoted on the market. So while there's a lot of international revenue, it tends to be revenue for local businesses. So I had a good look through the portfolio back in sort of March, April, when these things were talked about and then obviously initially implemented before they were pulled. There's probably only 3 or 4 companies out of the 90 who will actually directly pay a tariff of any sort. So it's not the direct effect that affects the companies, it's the effect on the economies and what's going to happen to the underlying economy. And clearly just the uncertainty itself about what the policy may be stops you being able to sort of do things. So again, there's definitely been a hold up in CapEx transactions, big business decisions, because you're not quite sure exactly what the new terms of business might be, or indeed if there is going to be a sort of change in the terms of business. So that's something, a sort of a stasis that's fed into bigger decisions, particularly actually if you're sort of based in the US, like, are consumers going to have to pay more? Am I going to have to maybe pay a higher tariff or build a plant here? Also, do I want to build a plant here because are these tariffs going to last more than the 4 years of the Trump term? Unfortunately, the effect has just been to sort of generally dampen activity, particularly when it's CapEx based.
Yeah. And that has longer term consequences that maybe the market hasn't quite priced in yet, maybe. So that's certainly one possibility, I would think, for sure. And what about domestically? I mean, we know there was a budget last year, I mentioned that earlier. That put some significant increases in payroll costs on some companies. And it looks like they're going to stay, even if other things are being changed in the UK economic policy kit, shall I put it that way. What do you think the impact of that has been? How are companies coping with those particular changes? Or are there others which are more concerning?
So we're obviously through those changes, which came in April. And again, there was a lot of, no one likes to pay higher taxes. And clearly there was a lot of noise because I think firms felt more able to push back against higher taxes. Whereas compared to previous years, payroll costs were also inflating at very high rate, but that was because the minimum wage was rising at 10% per annum, which it did in 23 and 24. And firms didn't feel that it was sensible to push back against sort of low paid people being paid quite a bit more. But the cost effect was basically almost exactly the same. So April this year, there was a 6% increase in minimum wages. And then the effect on a minimum wage employee, because of the change in the level and also for part-time workers, the threshold, was about a 10% rise. So again, there's no change in trend in what's happening to payroll. So retailers that we own, like Halfords in the portfolio, Frasers, they've had to live with this 10% increase in costs in 23 and 24, and they're living with it again in 25. And so, well, you can't say it's a good thing. It isn't really a change in trend, and businesses have dealt with it. And the main way they've dealt with it is they pushed up prices. So clearly inflation has stayed at slightly higher rates than maybe people were predicting 12 months ago, because effective employment costs have stayed at that elevated rate.
And now, of course, we've also got some employment rights legislation coming through Parliament as well, which may have an impact in terms of maybe deterring some kind of employment at the margin. You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's talk about the portfolio then a little bit and what you've been doing over the last, say, 12 months, if that's the right period to talk about. You said that's been a particularly strong period for you, helped by the discount narrowing on the investment trust. So what have you been doing over the last 12 months? Obviously, rising interest rates are bad for a lot of equities, a lot of companies at the margin, but they're also good for some types of equity, and banks and insurance companies go among those benefits. So I think you've had quite a big position in the financials, have you not? Have you been modifying that at all or adding to it? What's been your approach there?
Yeah, so financials have been a big position in the portfolio. Actually, pretty much the entire time I've run the trust, and they're still about 27% today. So they would still be the absolute largest position. We would have about 13% in banks, and then the same again in insurers and other financials. But we have changed that around a bit in terms of we have reduced actually the bank's holdings because, as you said, interest rates staying higher for longer has been beneficial for banks because it's meant that their net interest margins have stayed higher and they've been able to use that return to buy back more stock than people would have expected. So there have been some spectacularly strong performances from some of the banks. Indeed, the best of those, Allied Irish Bank, I think over the last 5 years is up about 500%. So it's truly spectacular returns from that sector. And so at the margin, we have been actually taking profit from these positions. So we've sold out of Barclays, we've reduced Allied Irish Bank, and then we've also reduced some of the life insurers, which have done well also. So we've trimmed the position in Phoenix, which was a very big position. Aviva continues to be a big position though. And so while we did trim some of that, effectively, we've actually got that position back with their takeover of Direct Line because that's going to be paid for sort of half in stock. So Aviva's still a big position. So we still like that area, but a bit less so because the stocks have done so well. And we have been actually adding to areas that have been hit by higher interest rates since 22. So in likes of sort of UK consumer plays, housing related plays, particularly ones that are linked to volumes. And that's been a bit of a theme of the last 12 months. So we've initiated a new position in DFS, the sofa retailer, a new position in Howden, the kitchen manufacturer, Genuit, which used to be called Polypipe, which is a supplier to sort of new house building and repair and maintenance, as well as actually some of the UK property companies, which sold off quite heavily when interest rates changed. So we mentioned earlier on sort of Warehouse REIT, who also Empiric Student Property, and New River REIT are 3 REITs that we own in the portfolio now.
And so the attraction of commercial property in this kind of environment, is it just a story of them recovering after what's been a pretty tough period for them?
So I think what's interesting is, while we did own CLS through most of the 2012 to 2021 period, that was pretty much the only property company because it was sort of secondary property with a high yield that could produce a high income return, whereas most forms of property went to very tight yields and therefore didn't produce very much income. Whereas today you can get some very good dividend yields out of property because yields have moved up. And so the companies we've bought have anything between sort of 5 and 9% dividend yields. So you get a big income return. And you are also seeing rents increase, particularly in categories like student accommodation, industrial, and even now at the margin in retail. So not maybe the 4, 5, 6% that you're seeing in those other categories, but retail rents are now growing 1 or 2% after having declined through most of the last sort of 15 years. So there's a good income yield, but then also sort of rising rents as well. So I think the sector makes quite a lot of sense just on an organic standalone basis, but also there's a lot of small companies out there and there's huge economies of scale in platforms. So again, we've deliberately bought small companies where we think there's the potential for either those companies to lead consolidation, which New River has done. They bought Capital and Regional, or potentially be subject to consolidation, a bit like actually Empiric and Warehouse REIT have been subject to bids from larger competitors.
And that certainly had an impact in the investment trust sector. Certainly, a number of names have disappeared is significant. Well, you've mentioned retail a couple of times, and perhaps you throw in hospitality as well. I mean, these are sectors that are perhaps most affected by what's been going on, by the consumer issues and the tax issues and so on, and the employment issues that you mentioned. Do you have much exposure at all to those areas now?
So we do have, if you look at retail, we just mentioned DFS. We've also got Frasers, which is a big new position, as well as Halfords. So as a total, we've got probably about 4 or 5% of the fund in retail. And I think retail is interesting in terms of they've had all those cost pressures, but obviously you think on the flip side, people have been getting higher wages, like disposable income has been growing above inflation. And so consumers do have the ability to spend, but they haven't been doing so on sort of bigger ticket items. What's been happening is savings rates have been going up as consumers sort of hoard that cash in case there's a sort of rainy day. And I think if we just do have more of a period of stability, maybe less negative geopolitical headlines, maybe interest rates continuing to fall, there is the potential that the UK consumer could actually spend that money, in which case that would be very beneficial for some of these more big ticket retailers like a DFS, a Howden. And indeed, you've not seen that bad trends. Like through Christmas, actually, we saw profit upgrades from both Halfords and DFS. So I wouldn't say it's a universally rosy picture. There have still been other areas where consumers are cautious, but on average, I think there is money to spend there, and the stocks are at very low valuations. So Fraser's a great example. That's coming up for a 2% position. That's trading on only 6 times current earnings. And actually, there's a lot of balance sheet value in that company that people don't maybe really recognize. So the company, quite unusually, this is the business that used to be called Sports Direct. So Mike Ashley's still the key strategic holder here. Also has stakes in many other retailers. So a stake in AO World, a stake in Boohoo, a stake in ASOS, a stake in Mulberry, a stake in Hugo Boss, as well as actually a large amount of freehold property, both their own property and third parties. So in fact, their portfolio is probably a good chunk of the kind of portfolio the New River REIT has as well. So I think that's a particularly interesting play, that because of its unusual nature and sort of the difficulty of analysing that company, often gets a very dislocated valuation.
Yes, I think many people could offer a number of reasons why that might be, but he's certainly a very entrepreneurial businessman, shall we say, who runs that particular enterprise. I guess I have to ask you about the oil companies. There has been this story about Shell and BP, which has been dismissed, possibly Shell taking over BP, but it's still a big part of the UK market. What are your thoughts about that? And one of the ones that's a bit harder to value, perhaps, in volatile times.
Yeah, so again, there have been times where we've been very positive on oil when it's been very out of favour. And indeed, there was a point back in 2020 where I think Shell became one of the biggest positions in the fund. And again, oil was something we also owned when it fell very dramatically in sort of 2015. Since then, though, with the big ramp up in the oil price, particularly around the Russian-Ukraine war, I think oil companies have done well and are now quite well owned. Shell and BP, I think, appear in the top 10 of many of my competitor funds. And I think actually today, the oil price is above marginal cost. There's no shortage of oil. There's a bit of a geopolitical premium in the price. And therefore, actually, oil as an investment sector for the larger names doesn't look that attractive. So we did used to own Shell. We sold out of that towards the end of last year. We do have a holding in Total, so that would be one of the non-UK positions. And then a couple of smaller ones, Energean, which is the Israeli primarily gas company, also Petrotal and Jadestone, which are smaller cap oil companies. So we've got some exposure, but it's quite small, certainly compared to the index in the UK, where it's about 10%. We've got more like 3.5–4% of the fund there.
So I'm just looking at up to the end of May, looking at your top and bottom contributors and detractors. And obviously, there's been a lot of issues around pharmaceuticals and biotech, and I see that AstraZeneca was your biggest underweight and yet still proved to be the biggest total contributor to the thing, if I've read that properly.
Yeah, so this would be on a relative performance basis. So you're right, not owning AstraZeneca has been the biggest contributor to 12-month returns compared to the index, because that stock has done badly. Indeed, actually, that stock's done so badly that we have actually started buying a bit of AstraZeneca. And so we've got about 2.5% of AstraZeneca in the fund today. I think Astra is a real success story, but had been very much priced as that. But clearly, there's been a lot of fears around tariffs on pharma, drug pricing on pharma, which has made that sector quite unfashionable. Now, I think those are real risks, because I think when you look at the cost of drugs in the US compared to the rest of the world, they are astronomically higher, and the profitability of these companies in the US is way higher than anywhere else. And so if you stand back and sort of take a common sense point of view, it does feel like there's a potential risk to that under the Trump government. Now, clearly, many previous presidents have also tried to address this issue and failed. So there is a chance that nothing happens. But I think this time it could be different there. So we do have a 2.5% position, but we're wary of having too big a position, because there is that sort of tail risk on something happening on pricing. And also, obviously, the sector's been hit because the dollar's been weak, and sort of dollar is by far and away the biggest part of sector earnings. Actually, Astra is the least sensitive because it has the least in the US, but when you say the least, it's still 44% of the profits of the business. So it is overwhelmingly still centered on the US market.
And if the dollar continues to weaken, which certainly is one of Trump's objectives, we know that, that could continue to be a factor, regardless of what happens on the tariff front, as you say. Perhaps I can ask you about the balance between large, mid-cap and small cap. You mentioned that before, and that can vary quite significantly in your portfolio depending on valuations, obviously, and opportunities. What's the current position and how is that different from where you've been in the past?
So the fund has always been very overweight mid and small caps. So sort of structurally, we have between sort of 50 and 60% in mid and small caps. And we have moved towards the sort of the top end of that range as we've sort of taken some profits in the banks, reduced some of the oil and pharmaceuticals, also taken a bit of profit out of tobacco, which has been a very strong performer over the last few years, and invested in some of these more mid-cap names that we've talked about in the more consumer-sensitive areas. And so that also has boosted the weight of the fund coming from pound-based earnings and reduced the weight of the fund coming from other currencies, including the dollar. So I think the index would be about 25% of earnings coming from the pound, whereas it's more like 45% for the fund today, which is a historically high level.
I was interested in another chart that you showed in a recent presentation. I thought that was quite interesting, looking at the number of funds and fund managers who are following a contrarian style, or perhaps I should just say a value style. You're obviously well known for that. Fidelity is well known for that being your approach and one you've stuck to. Do you think that's been a factor in how well you've been able to do? Because the competition, if you like, is diminishing. Is that a factor?
Yeah, no, I think it definitely is. We've been looking at this for the last couple of years and we particularly focused on it because the trust had its 30-year anniversary recently. So we sort of thought about how is the trust doing today compared to history? And we obviously talked about the remarkably similar performance over the most recent period and the ability to still add alpha. And I think over time, as a whole, equity markets generally, certainly on a stock specific basis, tend to get sort of more efficient because there tends to be more competition, more people looking, it being harder to get an edge. And that's definitely the case when you think about people who are investing in the big mega cap stocks. There'll be thousands of people, maybe even millions of people try and think about what's the next move on Nvidia, what's going on at Tesla, the minutiae of absolutely every statement coming out of those companies. Whereas if you look at the UK market, of just UK investors' assets, the UK market has gone down from 10 to 6%. And then if you look at how much of that is in value funds, that's gone down from 10 years ago, sort of about 2% of people's investable assets to 0.7% of people's assets. So that's a infinitesimally small amount. And because of that, and the absolute reduction in AUM from our competitors, so again, those sort of 8 scaled value funds in the UK 10 years ago would have been 14 billion. Today, they're only 10. Clearly, the amount of resource that therefore those fund managers have been able to put to analyze the companies has reduced. A lot of the people who would have been long tenured sort of value managers in the UK have retired. UK desks have been closed. And therefore, I think the ability to get an edge on some of these mid and small caps is that much higher because there just are less people looking. And that's even before we talk about things like MiFID II, which made sort of paid for research, sort of reduced the amount of sell side coverage. So again, the quality of the sell side, which used to be much higher 10, 15 years ago, is reduced. So information on these companies, in contrast to pretty much anywhere else maybe in the world, is actually down over the time that we've been managing money.
And that for you obviously is good news rather than bad news, of course. Yeah.
Yeah, so we want the market to be more inefficient. So again, it's sort of careful what you wish for, where people sort of thought, what's going to get the UK re-rated? What's going to get more people looking? Well, I don't want too many more people looking because then what we do will become that much harder.
And if I could just ask you about the investment trust, obviously some of the matters there are matters for the board. I mean, I think it's fair to say that historically, on average, you traded a discount more than you traded a premium. Well, I think that's been the case over the last 10 years. I'm just looking at a chart here. And at the moment, but the discount has come right back in again from what was quite a wide discount by your standards, 10% or so, I think. We talked about why that means for marginal demand. But the other sort of side of that is what you're doing about gearing. And that's one of the things you can do in the investment trust. And I'm looking at your numbers. I mean, your gearing is positive, but it's not as high as it has been, shall we say. So why is that if you're very positive about where we are at the moment?
So I think we're about 8% geared today, which I'd say is probably marginally below average. So on average, we've maybe been sort of 10% geared through time. And I think there's two reasons for that. One, Obviously, over the 13 years that we've been running the trust, obviously interest rates have been incredibly low for most of that period. And so the cost of borrowing was extremely low, whereas obviously now interest rates are higher and all our borrowing is on an overnight basis using CFDs. So we pay overnight rates plus a small margin, so about 40 basis points margin. So it's very efficient gearing, but clearly when interest rates change, the cost of gearing changes. So we have had sort of since 22 slightly lower gearing as that cost has increased. And then also, obviously, it has been a period while I'd say the UK market still looks on a relative basis compared to other markets very, very attractive. Obviously, absolutely, we are at an all-time high and we have had very strong performance. So naturally, there's more stocks that are working well and we're selling down. And when we're thinking about new ideas, we're maybe buying those a bit more gradually than we would because the market has been very strong and there is now a competing bid for those. So I think that would generally be how the gearing moves. If you look at periods where gearing has been at peak levels, it's been after the market's done badly and it's dislocated. So the highest gearing we ever went to was just over 20% in Q3 2020 in COVID, but not at the start of COVID, after we'd had a good think about what was going on, assess the fundamentals, and there were still lots of good opportunities. That's when the gearing built up to.
Again, I'm just looking at the performance. I mean, it's fair to say, I think that obviously, if you take a 5-year figure today, that goes straight back to that period coming out of COVID. And so the numbers look exceptionally strong over that period, but they were coming from a very low base, which you were able to exploit. But on a 10-year view, I mean, the performance of the trust, well, it's slightly, I think, above trend at the moment, but it's still very impressive. So are you pressing off another 10 years? Are you going to do another 10 years at this, Alex?
Oh, 10 years is a long time. So, yeah, no, I'm very much enjoying it. Obviously, Anthony started the fund all the way back in 1979 in terms of the open-ended version, which is the year I was born. I don't think I'm going to be able to do necessarily as long as Anthony did on the product, but it is something that, yeah, I'm very much enjoying. And certainly for the medium term, this is something I really want to do. These two products, the investment trust and the fund, are sort of Fidelity's original products. So they very much are the pinnacle, I guess, of what you could do here at Fidelity. And so I think, yeah, until I retire, this is very much what I'm focused on.
A final question then. What have you learnt over the period since you started in 2012? I mean, obviously you've been a Fidelity person forever, as it were, but you've been imbued with the philosophy of the firm. What have you learned since in terms of, putting this all into practice? What's been the biggest thing you've actually learned from the last 12 years?
Well, I joined Fidelity all the way back in 2001, and I've been managing money since 2007, initially on the smaller companies fund before special value. So I think what's interesting is after going through the GFC, I never thought we'd see another market with that degree of correction. And obviously we did in 2020. The fund had as big a correction in 2020 as it did in 07, 08. And instead of that occurring sort of over a 18-month period, it occurred in a 1-month period. So I think actually the longer you've been doing this, the more you learn extraordinary things can happen. Extraordinary things that people do not model in advance. And I think what's consistently important to remember is that those are the opportunities that produce the best returns going forward. So it doesn't feel like it at the time, but your best returns are always made in a bear market because it's what you buy at that point, which then recovers extremely strongly. And so when we see big drawdowns, big market dislocations, no matter what's caused them, no matter how bad it seems, we always try and make sure that we look at things anew from first principles and think about what things will then look like subsequently of sort of 3 or 5 years. And that's been the biggest lesson of just how volatile and how many different things can actually happen that you never really thought could happen.
And so I guess we have to conclude that they may well happen again at some point.
Yeah, they almost certainly will. Yeah.
Assume they will. Indeed, then what it really requires, you've got to have the discipline and the courage to get back in when things are really, really bad. And that's, I think, the cornerstone of your philosophy, really.
Yeah, and to be honest, again, you have to have a certain temperament to be a contrarian because I get excited when those things happen because you want dislocation, you want weird things to be happening. Like you don't want just a steady trending market where actually nothing's happening because that reduces your opportunity set. So having volatility and things changing is really helpful to the process.
And the interesting corollary of that is, to some extent, what's been happening with active and passive management. I'd like to ask about that. You're obviously an active manager par excellence and committed to that. But passives have carried all before them in terms of fund flows for most of the last 10, 15 years or so. Do you have any views on whether we're close to peak passive, or put it another way, what is the argument you can make for active after passive has put together what has been an impressive track record, albeit not as good in your case as your own performance?
Yeah, well, I think just going back to what I said at the start is that just the performance of the fund, we have beaten our index after fees by 4% per annum. And that is a very significant part of the return. The total return is 11.5%. And actually 4% of that is from alpha, only 7.5% is from the index. And so I can't think of a better advert for active management than actually the long-term demonstration of beating the market. And obviously, passive, you're not buying the best stocks or the most interesting stocks, you're just buying the largest stocks. And in the UK in particular, you can see that just in the last 12 months, as we talked about, some of the largest stocks have done very badly. And if you in an index, you owned all of those. So you owned all of Astra, Shell, BP, Diageo, all of which have had a bit of a nightmare in the last 12 months. And in fact, some of those have been good long-term performers. Some of them have been very bad. So to me, it makes absolutely no sense at all to own a passive fund because you're not intelligently choosing what you own. And actually, I would say it's particularly bad today because a lot of people will think they're getting diversification by saying, oh, I own like a global passive fund. So that sounds like a very diversified instrument. But actually, if you look at the global market, it's almost 70% US. And then of that market, it's incredibly concentrated into only 6 or 7 companies. So actually what you're saying is, I want to put all of my eggs in one basket, US technology basket. That is not a wise way to invest because you're also taking, as we talked about, a huge currency bet as well. You're betting that the dollar will be strong forever because you're taking a huge dollar bet as a UK investor. It may be different if you're a US investor and you have US liabilities to retire on, but in the UK, most people have UK liabilities. They want to live here and they want to live out their retirement in the UK. And so actually putting all of your eggs in a currency which isn't the pound is probably not a particularly sensible thing to do.
I would certainly concur with that. And of course, that applies to people like me more than many because we're at an age where we have to take these factors into consideration. So, Alex, thank you very much for your time and your thoughts. Very good to have you on the podcast. And I'm sure that many listeners will be interested in what you have to say and perhaps pleasantly surprised by what you've had to say about the UK market. And maybe they'll go out and spend a few more of their hard-earned pounds on investing in the UK market.
Yeah, very much hope that will be the case. And it's been great to chat. Thanks very much for having me on.
It's been a pleasure. So that was Alex Wright, the manager of Fidelity Special Values, the Investment Trust, and its somewhat larger sister fund, Fidelity Special Situations. We will be back next week, and I shall look forward to being in touch with you then.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.